Welcome back. We appreciate having you back. We're on page 10, and we're up towards the top of the page, we're down towards the bottom of the page, rather, with the types of risks that we see in different securities. Now, one of the things to keep in mind is that your mutual funds, your package products, will to a certain degree minimize some of these risks because of the diversification involved. But there's also certain risks that you cannot diversify away. And so probably the biggest picture to start at is market risk or systematic, or sometimes you'll see systemic risk. Those two terms are the same. The whole system is ill. If the whole market is going down, your chances of finding a winner are pretty well slim and none, okay? Yeah, every now and then you get lucky, but it's just it's more lucky than anything else. So if you have systematic risk, I say the rising tide floats all ships, but hey, a lowering tide, all the ships go down too. And then you have selection, business, or unsystematic risk. Now, the thing about that is that you can actually diversify away a lot of your unsystematic or selection risk, but systemic or systematic risk, like I say, you just can't diversify that out. You have to hedge against that. Then you also have financial or credit risk. I bought a bond. Will this company pay off? Well, I don't really know. Again, diversification will help to minimize that. But if you have a bond fund that has a lot of different names, but they're all low quality issuers, then yes, you've diversified out some of it, but it's still there. And again, even some very good credit risks turn sour pretty quickly. So anyway, you have purchasing power risk. Again, it's true with any type of fixed income investment. I kind of made the wisecrack in one of them that $20 every 6 months used to be a fancy dinner for two. I didn't specify whether that bond was a corporate, that was a junk bond, or if it was a treasury bond. It doesn't really matter. Okay? If you've got inflation, it's going to eat into that fixed income that you receive from the fixed return investments. And then reinvestment risk, again, we've talked about it before, that it's not present in zero coupon bonds, but that's the only place it's not present, because you just like interest rates go up, they also go down. And if you're taking those payments and having to reinvest them at a lower rate, you're not going to get that true compounded yield. Zero coupon bond is the only place where you're going to get a true compounded rate of return all the way to maturity. And then interest rate or money rate risk, interest rates go up, bond prices or preferred prices go down. Yeah, and see, that's your systematic risk when it comes to fixed income securities. So if you can have the best names in the world, it doesn't really matter. You can minimize that credit risk out all you want to, but if interest rates go from low to high, your prices are going to take a pounding. And then also timing risk. You may need to get out of whatever it is. I mean, I've had that happen to me where I had to sell something, but it was on a downswing. Doggone it. And if I'd just been able to hold on to it for 6 more months, it would have been a tidy little profit. Tough luck. The market doesn't care. So that's a risk that you have to provide for. And typically the way that you provide for that is by keeping enough in liquid reserves. Man, we get to the suitability section, that's going to be huge. It's going to be the first thing you want to look for. Does a person have good liquid reserves? If not, can they take that timing risk? They shouldn't. Okay. And then marketability or liquidity risk. We've kind of referred to this, with the lower quality stuff, the more obscure stuff, whether it's stocks or bonds, it's going to have more liquidity risk, going to have less marketability, going to have bigger spreads. Remember when we talked about spreads? We talked about that. Okay. But like for instance, if I buy a treasury bond, I tell you what, you've been there, all right? It's the fish restaurant that they build the thing with the deck that goes out over the pond where they've got the fish. I don't know if they use those or not, but looks good. And they've got the little gum machine on the railing that has the fish food. Yeah, you put the quarter in. You know what happens? You throw it out there, and when it's about that far away from the surface, I mean, the fish is hitting it right now, okay? And by the time it hits, it's gone. That's Treasury securities, okay? There's an insatiable demand for high grade, as high as U.S. Treasury, debt securities. And so you have one, there's going to be a buyer. You want to sell it, that's fine. But if you're talking about XYZ Incorporated, they were formed 2 years ago and they still haven't turned a profit, and you've got some subordinated debt, yeah, it's numbered underneath the others, you might find a buyer, you might not. It might be at the good price you want, it might not. So that's that marketability or liquidity risk. Legislative risk, laws, over on page 11, laws, including tax laws, especially tax laws, can and do change without notice. You won't be tested on this, but there was a type of investment that you need a Series 7 to sell, that there was a major change in tax laws because people were buying them only looking at the write-offs that they could generate against ordinary income. Congress said, "Hey, this is ridiculous. We're going to change the law, and we're not going to grandfather it in. It's just your tough luck." And there are people who probably are still carrying forward those tax loss carry forwards because they haven't been able to use them, and that's been years ago. Okay, so you have no guarantee that the laws won't change. Economic risk, good economy, bad economy. We've seen them both. I mean, it's and some companies do well in good economies. Cyclical companies are going to cycle with the economy. Just look up to Detroit. I mean, my goodness, that's a great city. But man, has it taken a pounding or what? Fortunately, starting to come back. Why? The economy's starting to come back. So it's tied to the economy. Businesses are like that. Social and political risks. Look at a movie from 1951. I don't care what movie it is. Somebody in there is going to be smoking. You think they could do that today? So like I say, it's just it's a social, it's a political type situation that's no longer acceptable. So like I say, tobacco companies are probably the prime example of that, but it's all over the place. The exchange rate risk. You go across the country, to a different country. You've got to buy and sell those currencies before you buy and sell those securities. Or at some point in time, you're going to encounter that currency risk, and so that actually that's a risk that's independent of the business risk that we're talking about. Because the best company in the world does as well as it possibly can, but the currencies go against you, it can wipe out all those gains and more. So, how do we avoid each of these risks? We've kind of referred to this, okay? Purchasing good quality issues. That's going to help to minimize that credit risk or default risk. The marketability risk. You're going to have tighter spreads. In fact, we had to go on the New York Stock Exchange, had to decimalize to where we went to a penny so that we could get tight spreads because there was so much activity. I mean, back in 1940, an eighth of a dollar, 12.5 cents. That's plenty good. There wasn't that much activity, but now there's so much that tightens those spreads down. Maintaining adequate cash reserves. Did I read that right? Let me read it again. Maintaining adequate cash reserves. Yeah, I think I read it right. Maintaining adequate cash reserves. Do I need to reemphasize how important it is to maintain adequate cash reserves? In fact, sometimes you'll see a situation that says, which of these people is least suited for this particular product? That's going to be your first choice, is the person who has no cash reserves. All right, and then short or staggered maturities. Because let's say that interest rates turn against us. But if our stuff matures in 6 months, how much pain are we going to endure? 6 months worth? Or if we've got 6 months, a year and a half, 2.5, 3, interest rates go up over the course of 3 years, what are we doing? We're getting every 6 months, we're getting money that we can then reinvest at those higher rates. So shorter staggered maturities, actively traded issues, diversifying, talked about this, helps minimize that selection or business risk, the unsystematic risk, but hedging, basically buying an insurance policy. Okay? You won't have the capability to sell the types of securities like options, like commodities contracts, okay, that will hedge against adverse market moves. But you do need to know that for systematic, the whole market's going down, they're going against you, let's put it that way. that's how you do it, is to hedge. And probably more importantly, that diversification doesn't help to hedge against that systematic risk. Back in the very early 2000s, okay, when the dot-com craze was going on, it was just everything was just going sky high, and then all of a sudden the bubble popped. If you had a dot-com mutual fund, you would be well diversified in dot-com companies. But then when it went, you would be well diversifiedly hurting, because you just can't hedge it, or you can't diversify out that type of risk. And types of equity investments that we have. And again, with this all starts to weave together now, and we're going to see more and more of that as we go down through the outline. But types of equity investments, we have defensive issues, and I'd be very familiar, especially with the first two or three of these. Defensive issues, needs and vices. I don't know about you, I ain't going to put up with a house that doesn't have electricity. It's just not happening. Okay? If I don't have a public water company, I'm going to pay my public water company. In the wintertime, I got a gas furnace, I am going to pay the gas bill. It's going to happen, okay? I'm going to eat. Yeah, I've done a little bit too much, okay? But I'm going to eat. I'm going to, now I may not be able to buy them every month to the full degree possible, but I'm going to buy my prescription drugs, in fact even non-prescription drugs. If I can't afford that brand name medicine, I might self-medicate with something over the counter. Okay? If I'm a smoker, I'm going to smoke. If I'm a drinker, I'm going to drink. In fact, sometimes those get better in bad economies, so they're almost counter-cyclical. Okay, but like I say, needs and vices, those are not really tied to the direction of the economy, because people are going to use those services and those goods regardless of how good or how bad the economy is. On the other hand, cyclical goes up and down with the economic cycle. Things are looking bad at work, you might lose your job. You've got quite a few bills, you're making it, that's about it, but you've already been cut back maybe 10 hours a week. Are you going to go out and buy a new car? Probably not. Furniture? Don't think so. Add that addition onto the house? No, Junior can stay in the room. They're just 5 and 6, so they can stay in the same room together now. They don't need to add that extra bedroom. Those types of things are going to be cyclical. They're going to go up and down with the economy. You get, the economy starts to improve. You not only get back to 40 hours, but they've now got you working 50 hours and 4 hours on Saturday on top of that. Guess what? Yeah, that new Dodge Ram looking pretty good. Okay, we're going to talk to that contractor about maybe tacking on that extra bedroom in the back. All right, then you have blue chip. Well-established, highly predictable companies. It is really hard to capsize a huge ship. We picked on Procter & Gamble here earlier. Everybody knows them. Okay? Procter & Gamble's sales go down by $1 million. Procter & Gamble's sales go up by $1 million. It's nothing. We know they're going to pay their dividend. They're just very dependable. Blue chip. Growth, less current income, or capital gains. Okay? So not to that blue chip stage yet. They're still going through the growth cycle. And emerging growth, small cap companies, yet higher volatility, because whatever Bob makes, you tack $1 million onto the top line of Bob's sales, and what happens? Boom! That bottom line just explodes. But you take $1 million off of Bob's top line, his bottom line is hurting now. Okay? So you've got more volatility, because just the same dollar amount is going to really hurt those small caps, or help the small caps, as opposed to the large caps. Okay? And then emerging markets, different economies, China, Korea, what have you. You have higher political, currency, and business risks, because you have new companies in a new and untested and sometimes politically unstable environment. Value stocks. A lot of times natural resource companies, what they own is not fully reflected in the price of their stock. Now, value stocks are going to be fairly stable. Typically, they pay a halfway decent dividend, and you might have to wait a while. But the idea behind value stocks is, and you've got value funds, of course, one of these days, people are going to realize, hey, those assets are worth a whole lot. And so they're going to buy it and push that stock price up. Be patient, not going to be real volatile, but one of these days it should pay off. And then income stocks, including public utilities. Public utilities, they just suck up so much capital. They need so much money to do what they've got to do. And how much electricity can you use? You only use so much, okay? So the thing is that the growth prospects aren't really there. Yeah, there's some over the course of years, but they buy investors. That's what they've got to do. In order to get that kind of money, they've got to buy their investors by paying them a good dividend. So public utilities provide income primarily. Yeah, if you get some growth along with them, it's cool, it's a bonus, it's a cherry on top of the sundae. But the reason you really buy them is mostly for that dividend. And then small cap versus large cap, we've already kind of referred to this. If you've got a huge ocean liner, it can take a heck of a wave. If you've got a little 30-foot skiff, put the same wave on the side of it and it's a goner. So like I said, on the other hand, you try to turn it. That big ocean liner it's going to take a long old time. You can do like that with a little boat. So much more nimble, but they can turn over a lot easier. Same way with in the marketplace. You can have disasters or you can have just colossal performances with your small cap. That's much less likely with your large cap because they're so slow to move one way or the other, good or bad. And then special situations like takeover candidates, turnarounds, spin-offs, things like that. At one time, the busiest guy in town was the sign painter for a bank. Yeah, because just to get the sign painted, and I'll be darned, that bank got bought out. So he'd scrape off his old sign off the windows, paint the new sign. What happened? Boom! I was in one town that downtown. In fact, I think it was Bank of America. There's the transom up above the front door is a stone transom, and it looked like St. Valentine's Day Massacre had taken place there. There's so many holes where they put this sign of this bank and that sign for that bank and the next sign of the next. Finally, Bank of America said, forget this nonsense. We're just going to put up a sticker. So, special situations. You basically, you go fishing where they're biting, and that's what you look for there. Or in fact, I know of a mutual fund company that what they do is that they focus on the small gems that are spun out of the large corporate crown. When there's a takeover or a leverage buyout, that a company will go private in a leverage buyout and then will start selling assets. Well, what do they sell? They sell this little company and that little company and that little company. And the thing is that they made that much money for them, but management of those companies said, we can do more. And it's done very well. Okay, but they're usually small cap, so it also gets pounded pretty hard when the economy or the market goes down. But those are all special situations. And then special considerations we have for international investing. Currencies do fluctuate in relationship to each other based on supply and demand for the currencies. Now, again, there are factors that drive that, like interest rates, relative interest rates, what have you. But bottom line is supply and demand for the currency itself. And you can actually have a situation where on business level, things doing great. On the net level, net of the currency fluctuations is doing lousy. So that's another level of risk that's put in within international investments. Imbalances between aggregate imports and exports into and out of a country is going to affect the balance of payments. With us, we typically import more than we export. Therefore, we typically have a deficit of the balance of payments. Then currency fluctuations, talked about that, creates that new level of risk. And products, imports and exports, are attracted to a strong currency. So that's one thing you may have possibly one question. Okay? again, remember that these are relative to each other. So if you have two different countries, and we start out, wherever you start is going to be the baseline, because it's all relative, okay? And what happens is that if it's equally desirable to import or export, okay, but this currency goes up, strengthens in relationship to that one, you can go through it, you can block it out and diagram it out, whatever. It's really not worth it for our purposes. The important thing is that stuff is going to be attracted over here to the strong currency, okay? Now, if you want to turn it into a semester class on macroeconomics, you can certainly do so at this point. It's not an economics exam. Stuff is attracted to a strong currency. A strong currency is a magnet for stuff. And that takes us to the end of this module. So we'll go ahead and close it up, and be sure to visit our sponsors, okay? And we'll see you in the next video.